Welcome back to the Know Better, Do Better series. I am Lauren Williams, and I am joined by my illustrious co-host, Chloe Moore. And I hope
not illustrious.
Illustrious, yes, girl. I don't know what that means in dictionary, so hopefully it doesn't have like a sexual connotation or anything. But I feel like it's a fancy word that I should use to describe you. Yeah. So, yes, we are here, and we are doing Know Better, Do Better. If you have not tuned into the series up to this point, please go back and check out some of the other episodes, because Chloe and I are dropping all kinds of nuggets for how people can know better so they do better with their own personal finances. At the top of every show, we do what we call Trends, Taxes, and Tea. These are the latest trends on how to save more and pay less, or we share some current event that has to do with money. So it is still tax season, and therefore today we are doing some fun tax facts. I know, say that 3 times fast. I know people sometimes think that tax can't be fun, but these are, I feel like, some fun tax facts, and they can be money savers. So Chloe, take it away.
Sure. So a couple of fun tax facts since we're in the middle of tax season. According to the IRS, the average taxpayer spends about 11 hours doing record keeping, tax planning, submitting their forms, and other fun tax-related activities, if you consider those fun. Right. Business filers spend about 20 hours, and that includes about 10 hours on just record keeping alone.
So I just want to pause here for a second, because I was really baffled when I saw this. I was like, is this really how long people spend doing their taxes? And I was like, I think this is how long people should spend doing their taxes, because the person I bump into on a regular basis does not spend this long on their taxes. And they're scrambling at the last moment, trying to pull stuff together. So I'd love to do a poll of our audience and find out, is this about how long you feel like you spend on tax stuff during the year? So if you want to write back, let us know how long you're spending on tax stuff, and is this number in fact right, or are they way off base? Please hit us up at podcast@worth-listening.com.
Yeah, we're both business filers. So I definitely feel like that's accurate. Of course, some business owners outsource their bookkeeping and record keeping to other outsourced professionals, but yeah, even just checking over that information, understanding books and preparing everything to file taxes it takes almost a day to pull all that stuff together.
For sure. So what else you got for us? Fun tax facts.
Yeah. So the other thing is for any of you who have income and adjusted gross income less than $69,000, you're eligible to file for free using what's called IRS Free File. So about 70% of filers qualify, which works out to about 100 million Americans.
So wait, there are 330 million people in America, and 100 million of them make less than $69,000. I think we need to just let that marinate for a second. But then on top of that, there is a free way to file your taxes. So I know there's lots of companies that are, offering free tax preparation now, and it's usually because they have the intent to sell you something. But you can just go right to IRS Free File and get it done for free 99 without being sold any stuff.
Exactly. Especially if you have a pretty simple return. I know sometimes, we always want you to work with professionals when it comes to your money. But there are some cases where you have a pretty simple return. There's not a lot going on. It's pretty easy to file yourself.
Yeah, I know another good resource too is VITA, which stands for Volunteer Income Tax Assistance. And their requirement is that you make less than $57,000 per year. So in the same ballpark, but if you go to Free File and you feel a little bit overwhelmed, or you're just afraid to do it on your own, and you want a real live person, you may also qualify for a VITA program. And you can just simply type in, like VITA tax prep online, and find like the nearest location to you to get your taxes done for free by someone that you can talk to.
Yeah, that's a great resource. And so our final tax fact, and then this one's kind of near and dear to me. Taxpayers lose out on millions of dollars by not filing tax returns. There's so many workers who don't owe taxes, and then they neglect to file their returns, realizing that there's some tax credits they could receive refunds for. And then also, I've seen this before. People don't realize that you have up to 3 years past the filing deadline to claim a refund from an unfiled tax return. So if you think the IRS owes you money from a previous tax year, it pays to file. I've had a couple of clients come to me and they haven't filed in 2 or 3 years, and they actually had refunds due to them. So, that's one of the first things that we need to get done right away.
Right. I think we need to normalize talking about getting our taxes done, and that Uncle Sam is not the man that is out to get us. I think everybody thinks, taxes are bad, paying taxes are bad. Like you said, the government, the man is out to get you. All those, there's so much narrative and negativity around the actual tax filing that you don't realize that if you're a person in some sort of financial distress, or if you're, living below a certain economic means, you have a lot of benefits that are available to you that actually are beneficial by being a part of these programs. So you don't want to run and hide. Now, I know the latest thing that's come up is stimulus checks. A lot of people didn't get their stimulus because they have not filed. They're like, oh, wait, I want my $1,400. Hold on. Send me my check. And so now people are starting to get the idea that the government is not all bad and out to get you. And like I said, just trying to take your money, but that we're in a system where we're all paying into together and that it can benefit you greatly.
Yeah. And even on the business side, a lot of businesses suffered because they haven't filed tax returns, or they've manipulated their returns to where they have losses every year. Mm-hmm. And so, when it came to getting qualifying for COVID relief, whether it was the PPP loans or the EIDL loans, a lot of people couldn't qualify for those.
Yeah, I think that's a huge one. People love to write off every single thing as an expense and like, I'm not paying the man nothing. Look at me. I spent all my money. Well, if you spent it all, that means there was not anything left over to be saved. But also, like you said, you might have missed out on some opportunities when the EIDL and the PPP loan rolled out, during the pandemic. And at the point at which people needed it at most, they weren't eligible because they had spent so much time trying to make sure they didn't pay anything in the past, which I think is a great segue into the topic today is we are talking about expenses. So little expenses do add up, but big expenses are the things that I think people sometimes miss out on. They just feel like these are things I have to pay. It is what it is. And, if I just spend less money at Starbucks, my life will be better. Kind of a narrative that we hear all the time. Maybe there is an area that you can improve on your little expenses, but those big expenses are the things that sometimes are killing people and they don't even realize it. So, Chloe, talk to us about some of the expenses that happen and what we should do to make sure that they don't wear us out.
Yeah, so I feel like there's kind of a big three when I think about the big expenses that really kill you and just mess up your ability to build wealth and just have a huge effect on your stress levels and just overall financial health. And so those three are taxes, housing, and debt. And so we're going to dig into each of those individually. And so we're first going to start with taxes because, of course, tax season, fun tax facts.
Right.
So why don't we start with taxes?
Just going to keep the good times rolling.
Yeah.
So one of the things I think of when I think of taxes and it being a big expense, especially with dealing with clients, is that it is really the largest bill that we pay because it comes out of your check. Generally, if you work for an employer and you don't see that money coming out, and so your paycheck is already a lot smaller. You make $100,000 a year, or you make $500,000 a year. You don't actually see that amount coming home once the taxes and all the other things have been deducted. And so sometimes we kind of get our mindset around, I earn $500,000, or I earn $1 million, or I earn 100,000, whatever your number is. But you don't realize that a huge part of it is being taken out because you see it just taken right off the top. So yeah, what do you think about, taxes and what needs to happen to take care of this big expense?
Yeah, it's like you said, it's definitely the largest bill. Most people think housing is your largest bill, but taxes are your largest bill. And the wealthy understand this. There's a lot of factors that go into the wealth inequality gap. And you think about how much or how little in some cases that wealthy people pay in taxes. They understand that this is their biggest bill, and the most they can do to keep it down, the better they can protect their wealth. So that's something that you kind of want to think about and just understand how to reduce your tax liability. So
I want to just pause here for a second because I think you brought up a really good point. You said the wealthy understand this because I think, once again, narrative wise, what we hear is a lot of noise and via social media and stuff now. And people are starting to get the idea, well, the wealthy are doing these things. We need to be doing these things as well. But these things are actually like more scam oriented than strategy oriented. So what the wealthy are doing is taking advantage of tax strategies. They're using an accountant, a professional to, know and understand how tax law works and what is feasible within the law that's actually legal to do. Whereas sometimes, people who are uneducated and are looking to know better, do better, misunderstand and feel like they're missing out on something. So they're doing things like, let me claim all your kids on my tax return, even though I don't look after any of them. That's not a tax strategy. That is not something you should be doing. So there's a difference between strategy and actual, fraud that happens in order to take advantage of these things.
Yes, that's a very good point. Yeah, and so one of the things I wanted to talk about with tax liability, there's kind of different camps that people fall into. There's of course like the salaried employees or W-2 workers, and then there's business owners. And so there's kind of different, ways that you can reduce your tax liability depending on what camp you're in. If you're a W-2 employee, there's not that many options available to you. I have people, come to me all the time, and I'm sure you do, Lauren, and say, they're W-2 employees are like, how can I reduce my tax bill? And I mean, unfortunately, there's just not that many great options. The biggest one is your 401k. You can contribute in this year, 2021, up to $19,500 into a 401k. You can contribute a little bit more if you're above the age of 50. But that's the biggest way to get bang for your buck as far as reducing your tax liability, and you're saving for retirement at the same time.
Yes. Well, just before you go ahead here, I wanted to just kind of jump in because, once again, narrative wise, what I hear with my clients or people that are reaching out to me all the time is like, Roth IRA, I have a Roth, and they're putting just 3% into their employer retirement plan. $19,500 is a good bit of money you can stock away for yourself. It's going to get you on track for retirement. You don't need to be an investment guru, so it simplifies your life. And, to Chloe's point, you can lower your tax liability quite a bit. So you want to pay less in taxes. The best way to do it is to load up your own retirement savings, be putting money away for yourself. Your HSA is another, like she said, medical savings accounts that are going to lower your tax liability, but it's money that's still in your possession. So I'd much rather reroute dollars to me and get that money later on than to be rerouting that money to Uncle Sam. So regular 401ks, HSAs and things like that. But Roth is paying the taxes now. And, that's one thing you're not doing is reducing your tax liability in the moment. So if that's important to you, you want to consider that.
Yeah. And I wrote an article that we'll share in the show notes to talk about the difference between a traditional and a Roth 401k and when it makes sense to contribute to each of those accounts. Some things to think about. So we'll include that. And then in addition to I know you mentioned health savings accounts. There's what's called flex spending accounts. And so depending on if you have a high deductible plan, you might be eligible for one versus the other. If you have children, there's dependent care flex spending accounts. I think a lot of people, forget about those. But that's, money that you can set aside that you're going to spend on your kids anyway. Why not get a tax deduction for it? But just take advantage of some of those things that are available with your company if you're a W-2 employee.
For sure. But then there are people who are entrepreneurs, whether they're solopreneurs, big business owners, small business owners. And a lot of people are ready to leave their 9-to-5, just to save money on taxes. And they want to become a business owner because they heard you get to write off so many more things. Is that true, Chloe?
Yeah, within reason. Yes. But yeah, as a business owner, you do have business expenses that can offset income. We're not going to get into the weeds of that in this episode because we have a lot to cover. But yeah, there are a ton of things that you can write off. Like we said, within reason. Mm-hmm. And so you definitely want to consult with your tax professional if you have a business, just to make sure that you're taking advantage of all those different write-offs.
Yes. And I just say too, to just be mindful of the fact that expenses still are expenses, whether it's getting your nails done or buying a big fancy software for your business, it's money that goes out. And I think that's the part sometimes we take for granted. We forget about the fact that like 1 + 1 is always going to equal 2. 1 - 1 is going to bring you down to 0. So the math is going to work the same. Money going out, you need to be mindful of. And so while, like I said, you may pay less taxes, you know, having that big fancy software that you're never going to use just to say that you didn't pay taxes on it, you know, doesn't make your business any healthier. So always be mindful of the purpose behind your expenses.
Exactly. And then in addition to the employees and business owner, there are some common, tax credits and deductions that anyone can take. So we'll kind of briefly go over those. But just the difference between a tax deduction and a tax credit, for those of you who don't know, a tax deduction is something that reduces your taxable income, so dollar for dollar. So like I just mentioned, the 401k, if you put $19,500 in your 401k, you're reducing your taxable income by that amount. And so that's money that you don't have to pay taxes on. A tax credit, on the other hand, directly reduces your tax bill. And the great part is that some of those are refundable. So let's say, as an example, if you owe $5,000 in taxes and you get a $500 tax credit, then that reduces the amount that you have to pay to $4,500.
I love it. I love it. I love it. And then there's this idea of kind of like above the line versus below the line deduction. So you may hear tax professionals talk about things like that. But, when I think of above the line deductions, those are the things that are going to lower your adjusted gross income is what we call it. So we think about educator expenses, HSA contributions, student loan interest, Lisa, those retirement contributions. And as a student loan professional, what comes to mind to me here is a lot of people don't realize that your adjusted gross income is the number that they're using to calculate your student loan payments if you're on an income-driven repayment plan. So once again, you want to pay lower in your student loans on a monthly basis. If you're going for something like a 20 or 25-year taxable forgiveness or public service loan forgiveness, that's a really great goal. And a great way to do that is, like I said, redirecting those dollars to your retirement. So I put $19,500 away for myself. I save money on taxes, as we just mentioned. Loaded up my retirement, so I'm getting on track for that, which we all say we want to do. And this now gives us the motivation to do that. But thing number 3 is that it could also save you money on your student loans, which is going to help you maximize the forgiveness for whatever strategy you're using. So it's definitely something to look into if you're in the camp of, pay slow but steady, and not in the, I'm trying to pay aggressively. If you're trying to pay aggressively and get your loans paid off, then you need to, take a different strategy.
Yeah, and so that kind of goes back to the, when you want to bring a professional in and kind of figure out how to prioritize those things, when it makes sense to reduce your AGI or adjusted gross income, and when it makes sense to redirect money towards other things. And so the other thing that you might hear, in addition to the above line deductions, which is things that reduce your adjusted gross income, there's what tax preparers call the below the line deductions. So that's what we call the itemized deduction. So if you think about whether you take the standard deduction, or if you itemize, if you have more things that you can deduct above the standard deduction, that's when it makes sense to itemize. So that's what we're talking about here with these deductions. Those things could be medical expenses, but they're above a certain threshold based on your AGI, state and local taxes. So just think about your income taxes that you pay, your property taxes that you pay, in some cases sales taxes, mortgage interest, charitable deductions. All of those things are things that you itemize. And if that amount adds up to equal more than your standard deduction, then it makes sense to use those deductions.
Mm-hmm. And I know I'm kind of getting ahead because our next big expense has to do with that roof over your head. But another one that I hear all the time is, like I said, people want to buy a home in order to save themselves money on taxes. And this below the line deduction is the mortgage interest. So, you need to really understand what about the home is going to reduce your tax liability, and then do some analysis on, is the expense that I'm taking on going to be worth the tax benefit that I'm going to get from this? So.
Yeah, because one of the things that changed with I think it was in 2017, the new tax bill that came out, the standard deduction was increased significantly. So a lot of people don't itemize anymore. Mm-hmm. So if you're a married couple, you have over $24,000 as a standard deduction. And so, if you don't have a lot of mortgage interest or other things that you can write off, you might not even take advantage of that owning a home as you think.
Right.
As you think
it's going to lower my tax liability just because I got the house. Right.
Yeah.
Another myth that we got to make sure we understand behind what people are saying. There's these narratives out there, but what does that mean for my personal situation? Just to circle back to those tax credits. So there's the child tax credit, retirement savings. There's an education credit. There's actual credits for green purchases. So those things, like you said, tax credits are going to reduce your actual tax liability. So you get through everything and it says you owe $10,000. These credits are actually going to reduce that amount that you owe. And like I said, some of them being refundable means if we get all the way through that $10,000 in my example, you don't owe anything, that you could actually still get money back because some of the credits are refundable. Not all of them are.
Yeah, and the two biggest ones are the earned income credit. So if you're lower income, that's something that you can definitely take advantage of that's refundable. And also the child tax credit is something else that you could take advantage of.
Yeah, the other thing I think of too is, a lot of people are doing these investment apps and things like that this year, and they don't realize that they're going to get a tax liability associated or a tax document associated with, they're jumping in the market and maybe using their stimulus check or some additional funds they've been able to save to kind of play around with the investment market. So circle back to that 401k just one last time. It's pre-tax dollars. You don't have to worry about it. You don't need to become an investment guru, and you don't need to pay any taxes from one year to the next. However, if you open up, Robinhood and Acorns, one of the miscellaneous apps, or, even just playing around with some of the bigger investment platforms, and you're investing in what we call a brokerage account or a taxable account, then you need to understand how taxes on those investments work. So there are dividends, there's interest, there is what we call short-term capital gains and long-term capital gains. So short-term being you hold that, you buy some Tesla stock now, you sell it in 3 months, trying to, flip your money or make a quick buck off of it. Where you sold it short-term, they're going to tax that as if it's ordinary income. Which is probably a much higher tax liability than you would pay if you held on to something for at least a year. That's what we call long-term capital gains. And then you're taxed based on the long-term capital gains rates. So much lower probably tax liability if you wait for long-term cap gains to come around, unless you're in one of those lower income brackets.
Yeah, and I'll share too, just, in our financial planning and investment communities, we've been seeing a lot of these, 1099s, which are the documents that report all of these trades and the dividends and interest on the accounts. And I mean, for some people who are day trading or are really actively trading in their accounts, I mean, they could have multiple pages and, we could see hundreds or even thousands of transactions. And at the end of the day, you might have only gained a few $100. Mm-hmm. And so you just have to think about, is this worth it? What am I really trying to accomplish at the end of the day? And on the flip side, another thing I wanted to mention, since I work with a lot of tech employees, is, sometimes like I work with people who have a lot of company stock. They have, equity in their company through restricted stock units or stock options or an employee stock purchase plan. And so you need to think about if you want to reduce that concentration, which is a good thing to do. You don't want to have all your eggs in one basket, but don't just make investment decisions with just the taxes in mind. We just told you to be aware of the taxes, but you also, don't want to, as we call it, let the tax tail wag the dog. If you've made money, that is a good thing. And so sometimes it just makes sense to capture those gains and diversify your portfolio.
Amen, amen, amen. I think we have taxed the people accordingly. Hopefully you all learned a good bit of information there, but taxes, number one big expense that people take for granted and don't realize is a big expense that you can, use some strategies to make sure that you're maximizing your household income. Big expense number two is, in fact, the one that most people think is number one. It's housing. Yes. So housing expenses can wreck your budget. And I think we've gotten a little bit of a reputation. We got some people writing in and saying they've listened. They're like, you guys hate home buying. And we're like, no, we don't hate home buying. So It can wreck your budget whether you rent or you own. And we are not, in fact, against home buying. We just want people to make good decisions. Like I said, this is all called the Know Better, Do Better series because we want you to understand what you're up against and how you can really create wealth by, maybe waiting a a little longer, or, setting your finances up in a way that's going to optimize based on your personal situation, not just clickbaity articles or narratives. So, all right, housing, let's get this party started.
Yeah, so thinking about, just how much can you afford and what makes sense, whether you're renting or you're owning. We tend to err on the side of being conservative. So we think that, good conservative rule of thumb is no more than a quarter to a third of your take-home pay should go to rent or mortgage payments. And when I say mortgage payments, I just mean, your traditional property taxes, insurance, principal, and interest on the loan.
Okay. So I think we need to break it down. He said, I think sometimes, as you're listening, you're like, okay, that makes 25%, but what does that really mean for my finances? So let's say you have 10K of income on a monthly basis. If we're saying no more than 25%, that's 10K take home. That means you make, so 10K gross, just to be clear, would be 10K every month, before everything was taken out, which means your whole salary is 120. You're not in fact bringing home that amount. So you're going to have a salary much higher than $120,000 if you're bringing home $10,000 every month. So in this example, though, you're bringing home $10,000 a month. 25% of that means you should have a $2,500 mortgage, right? Is that what you're saying, Chloe?
Yes. And on the high end, it could be, $3,000, $3,500 in that range.
Gotcha. So that may be making some people hit the brakes on their car. I hope we didn't cause any wrecks, but I know a lot of people are not bringing home $10,000 a month, and they have a mortgage that's much higher than $2,500. But this is a good rule of thumb, and this might be where you said we refer to it as house poor, or an area where you're super stressed out and you feel like you're just working to pay bills. It might be because you've taken on more mortgage than your household expenses, and otherwise your income could allow you to really do comfortably.
Yeah. And then another thing, just think about how much debt you have. Of course, the percentage could be a little bit higher if you have a little to no debt, or it needs to be a lot lower if you have debt. And I know, student loans is a big thing, Lauren, if you want to talk about that quickly.
Mm-hmm. So I want to go with an example again, because like I said, I like to make it real for people. So let's say we got $175,000 of student loan debt. And I've got $250K of income. I got a great income, Chloe. Is it a good idea to go get a $750,000 home and maybe put like a $40,000 down payment? Why do you instruct people to kind of go a different direction? I got great income, $250K. I'm single, and I'm going to go buy a $750,000 home, and I saved $40,000. I got a down payment. I'm approved. I'm good to go. What are you recommending, based on the fact that I've got these student loans and the down payment and the income I just told you?
Yeah, and I think that just goes back to everybody's situation is different, but you have to think about what are your goals. What are you? How much are you saving for retirement right now? Are you on track? Mm-hmm. If you buy this house, will that get you off track? If you're not even saving enough now, you definitely won't be able to save enough once you buy a house. And I think another thing to think about too is just look at your total amount in debt that you're taking out. I think we, as a society, have just become so casual about taking out debt for various reasons. And just in this example that you gave, where someone has $175,000 of student loan debt and they're wanting to buy a $750,000 house, I mean, that's close to $1 million in debt. If you don't have any savings right now, if you don't have any money saved for retirement, your net worth is almost negative $1 million. Like, are you okay with that? Do you realize you're going to have to dig yourself out of almost $1 million hole just to break even before you can start to accumulate wealth?
Yeah, I think that was so well said. And I think that goes to, like I said, what the narrative is like, I got to be a homeowner because a homeowner is how you create wealth. But you don't realize, like, if you're borrowing, you owe someone. And the longer it takes you to pay them back, the more you pay that person. And in addition, if you do just a minimum down payment, so a $40,000 down payment on $750K house, it's just 5%. So you save the bare minimum, which means you're going to have a much higher mortgage. And then, you've got to be able to keep that $250K because now you owe, 3 times, you bought a house that's 3 times what you earn. That's a pretty big mortgage to take on and be committed to, and then also try to have enough money to pay down student loan debt. Because I can tell you as a student loan expert, you know, $250K of income, I'm going to be talking to you if you just called me for a student loan consultation and telling you need to pay that debt off. You're not in one of those situations where we should be talking about the long-term tax liability. So 175 is not a little bit. You can live in a house that's $175,000. And that's the thing that's kind of daunting to people. Like, how am I ever going to pay that off? But then they kind of flip another switch in their brain and say, you know, it's okay. To buy a home. This is going to be my dream home. And it's not as big a deal when you take on $750K of debt for a home versus your student loan. So we definitely need to normalize, you know, talking about buying a home that you can actually pay off. And really just being mindful of the different types of debt that we have.
Yeah, and the total amount that you have.
For sure.
Yeah. So just, you know, thinking about some ways to reduce your housing expenses. I mean, some of you might be in a situation where, you know, your cash flow is tight. You might have $7,000 coming in and you realize, you know, your mortgage payment is $3,500 a month or, you know, $4,000 a month, and you don't have a lot of wiggle room, and you might still have student loan payments and, you know, a car note, and you still have to buy groceries and food and and, you know, gas and utilities and everything else. So whether you're, you know, kind of just starting out or you know, kind of in a current situation, just think about when you're relocating or changing jobs, pay attention to the cost of living. Make sure that you can afford to live in your area that you want to live in on your salary. You know, a lot of people get tempted by a big bump in income. Let's say you're making $150,000 a year, and someone offers you $180,000, but you have to move across the country, and it might cost more to live in that new area. So, you know, is that $180,000 going to really get you where you need to be, or are you still just going to be breaking even, living paycheck to paycheck? So just think about those things and understand, you know, what you're worth. Understand, you know, what the market bears as far as salaries and where you want to live and the lifestyle that you want to live.
Yeah. And I can't drive home the point enough about like negotiating when you have a new job opportunity available to you, because the cost of living is a big deal. So, you know, they might just compare apples to apples, and also to be mindful not to tell the employer like, oh, I was making $150 at this job, because they might have been ready to pay you $250 and now they're just going to say, oh, we'll give you $180, and you're like, whoa, I'm winning. But one, you need to take into consideration, like you said, moving expenses, et cetera, cost of living. But two, you know, what is actual proper salary based on what I'm trying to accomplish. So I know that's a whole nother podcast for a whole nother day, but to be mindful of that, to make sure that, you know, as we talk about closing wealth gaps and things like that, that you're not selling yourself short by, you know, maybe being underpaid and just getting a small bump when you could have got a much bigger bump up to market value. Yeah, definitely. And another thing to think about is just evaluate whether renting or owning makes sense. And you know, we can put in the show notes our previous episode. I feel like we've talked a lot about that, and I've written a few articles about that. But you know, just understand if you know the difference. And when I talk to people, a lot of times, you know, I think one of the narratives out there is that, you know, owning is cheaper than renting, and that, you know, if you own a home, your mortgage doesn't go up, but if you rent, your rent's going to go up. But there's so many different narratives out there, and people don't talk about like big picture what that really looks like. And you know, every person that I personally have talked to that rents and wants to buy a house, they're typically taking on more. Like you know, I talk to people who have great rental deals. I mean, even in the Bay Area, I'm wondering how they were able to pay such a small amount of rent, and then they want to buy $1 million house. And their payment's typically going to double, or I mean, I've seen in some cases where payments could triple. And, you know, are you putting yourself in a good financial situation by owning? Is it really that much cheaper? Or if your mortgage is the same, or if your mortgage is slightly cheaper, when you add up all the other cost of home ownership, you know, how does that compare to your rent? And so one of the things I saw recently is that, you know, a mortgage is basically the least that you'll pay, and the rent is the most that you'll pay. Ooh, that is well said. Yes. Because property taxes and insurance are constantly creeping up on you. Yeah, it is. Yeah, that's a really good way to say it. Another thing I would say, though, like you said, is what's important to you. So if you are like, yes, I want to live, I want my home, I'm going to set up shop somewhere for 30 years. I can't wait to have my own yard and, an orange tree in the backyard. That's awesome. What are you willing to do to get there is the next thing. And I want to say, once again, we always talk about normalizing. Let's normalize it being okay to get a roommate for a while, to save money, to move back in with your parents, with a grandparent, some family member. In order to get to your savings goal, but you also actually have to execute when you get in that household. One thing I see frequently is people, move in with someone, so expenses have gone down significantly, or maybe you move in with a parent and you pay no rent or bills whatsoever, but you're still living paycheck to paycheck. But the goal to do that, like I said, if you want a home, you should be able to save gargantuanly to get to that goal so that you can put yourself in a great financial position. And not just for the down payment, but also have the emergency fund, also have the furniture fund. So if you get, if you're blessed with the opportunity to have someone to live with to cut those expenses because you're working toward a goal, get really aggressive, get really excited about that opportunity, and make it easier for yourself. If you really want this, why pay rent downtown in a walkable area and try to save for a house if you have the opportunity to live with someone for a year, save that $2,200 or however much it costs, plus, additional above and beyond that.
Yeah, your future self will thank you for it. That's one of the things too. I think, especially and I think in the Black community, it's like we don't always have the opportunity to live with our parents. Like they're trying to push us out as soon as they can. And it was expected that when I graduate, I got to get my own place. There wasn't the opportunity to come back home and live rent free. But if you're fortunate enough to have that opportunity, take full advantage of it, please.
Awesome. So the moral of the story is don't buy too much house. Big expense number 2, which is a great segue into what we call big expense number 3. It is good old fashioned debt. And so house is mortgage debt, but there are tons of different other kinds of debt that can weigh us down and become those big expenses that we just can't get from up underneath so that we can actually start working toward creating wealth.
Yeah, and the big thing to note here is that, more debt equals higher fixed expenses, which basically means you're living paycheck to paycheck. When I talk to clients, one of the first things we do is look at budget, and I know you do that too, Lauren. And we sometimes look at their budget and realize, okay, you have $5,000 or $6,000 a month going out to pay debts. That could be a combination of a mortgage, student loans, car loans, credit cards, maybe personal loans or consolidation loans. But I mean, if you think about like that's what keeps you up at night. If you think about, I have to make at least $60,000 to $80,000 just to cover my debts before I can live. Like that's how much I need to bring home. Like that's why you're stressed out.
Yeah. And I want to say too, the thing that I hear quite a bit, and I think, like I said, mindset is such an important part of changing your finances, is somebody will say, well, I can pay all my bills every month. I pay my bills on time every month. And that in and of itself is an accomplishment, which I can imagine, like you said, especially in communities where you come from, a place where maybe, your parents couldn't pay their bills on time or lights are being cut off and things like that. You're like, I'm doing it. I am paying all these bills every single month on time, but there's nothing left over to save is the problem. And so you might think that you're in good shape simply because you can pay your bills, but the goal is not just to work to pay bills. It is, in fact, to, like you said, be in a situation where you can save, and then you can increase your savings so that you can get to, your other goals faster by taking on additional debt every time you free up, a little bit of money, and just being able to pay the bills. You're not going to actually allow yourself to move forward.
Yeah, definitely. And that's something too that, a lot of people don't pay attention to their budget. And some people think that's a bad word. But you need to think about, how much do you really need to live on, and how much are you allocating towards debt in total, and how could that money be reallocated somewhere else? If you have a little bit of extra money, it might be easy to go out and say, oh, I can afford a car. Like it's only, extra, $600 a month, and I can figure that out. But all of those little amounts add up, and that's how you get to the $5,000 a month going out just to pay debt.
Mm-hmm. All right, let's talk about some of the types of debt that fall into this, other category. Like I said, outside of the mortgage. So student loans, we kind of talked about already. I have seen student loan balances that are very similar to mortgage monthly payments, and sometimes even higher. And that's the thing that freaks people out. You're just like, wait a minute, I cannot live in these student loans. Like, they do not house me. They can't give me shelter. What am I doing here? And so as we think about like how to reduce or even just avoid getting student loan debt, one, if you haven't borrowed yet, think about scholarships, whether you're going to graduate school, some postdoctorate, something. If you're in college and thinking about, heading to college, or if you're a parent of some students getting ready to go to college, scholarships are a thing. They do require the investment of time, but they can pay hugely by lowering the amount of debt that you take on in the first place, so that you're in a much better situation.
Yeah, definitely.
Yeah, go for it.
Yeah, I was going to say the other thing is that I don't think people think about enough is consider your earning potential and how that compares to the debt that you're taking on. Whether you're starting out in school and you want to major in something that doesn't pay well, but you end up graduating with maybe $60,000 or $100,000 in debt, and you can't even make $60,000. That might be a problem. Or if you're going to graduate school and you're working in a job, like think about how much more earning potential you have and how much more you can make once you get that graduate degree. And is it worth taking out that extra $100,000 in debt to go to business school and get your MBA? Yeah,
this is huge. I think that people also have to do that kind of reality check, like get your plan before you take on this debt. So two things I think of, two professions that I think of right off the top of my head: chiropractors and veterinarians, where potential income is very seldom in line with the amount of debt you have to take on in order to pursue either of those careers. And a lot of people are like, well, I'm going to have my own practice as a chiropractor and it's going to go great. What are the actual steps that you need to take to have your own practice and for it to go great to get you above the average, which is around $65,000. So you take on $250,000 of debt to make $65,000 as your full earning potential going forward. You're going to be strapped for cash. You're going to be, on one of these income-driven plans, and things don't pan out. Now, yes, have I seen a chiropractor that makes $200K? But is that the norm? No. And so you really have to be realistic about, am I going to be the exception of the rule? And if I am, what are my plans to actually be that exception to the rule? Veterinarians, $400,000 on average of student loan debt, $120K of income, $120K. Everybody wants to be a six-figure earner. So you're like, yes, I'm over 100,000. 120 is usually more on the high end. Somewhere between like 80 and 120 is what I've seen for most veterinarians. And so once again, a bunch of student loan debt in order to go out and do that thing that you love. And nobody is trying to say don't do it. I have a dog. I very much appreciate those that are highly skilled in this area, but understand what you're taking on and what your options are and what the best ways are to go about that.
Yeah, and the other thing too is take out only what you need. I know a lot of people want to take out the max because it's available, and that's one thing that we talk about a lot, and it just drives us crazy. Just because something's available to you doesn't mean that you have to take it when it comes to debt. And so don't take out loans just to cover your living expenses. Don't take them out just in case. That money adds up over time.
For sure. And so I already talked about scholarships, but also not being afraid to work. So the reason a lot of people take out as much as humanly possible is because they don't want to work. They just want to be able to focus on school. But you should be able to kind of do work-life balance. A student athlete has to go to practice and also go to class. Someone who plays an instrument has to do those two things. Some people who have children are balancing two things. So just kind of have that real conversation with yourself about, can I really, what am I doing with my full day? And am I really going to be fully exhausted by just focusing on school? Or can I take on a couple hours of something to get the student loan debt down, or keep it manageable so that I can be in the best position once I'm done with school? And grants is another thing as well. There are all kinds of different grants, which similar to scholarship, like you don't have to pay them back. So that's a cool thing versus taking out a loan that you actually have to repay.
Yeah, and I'm going to plug you here, Lauren, but I think, just getting professional help before you take out the student loans is important. A lot of people want to get help after they've done the damage, but if you can get someone to help you beforehand, that's even better. But either way, Lauren is a certified student loan planner. This is an area of expertise for her. So if you need help with that, she can definitely help you.
Student loans are my jam. That is my thing, girl.
Yeah.
All right. Car loans is another type of debt. So I feel like this is one too that people write off way too quickly. It's just like, oh, yeah, you just don't pay a car off. I got to get a car. I need a new car. It's going to be safe. And I'm just always going to have a car note. However, a car is something that you can, in fact, pay off. Ask somebody who has just like 30 or 40K of student loan debt, and is working on paying it down. It is possible. And that's like kind of the average car price nowadays. So you can, in fact, get this thing paid off and be done with it in its entirety. So want to, like I said, once again, normalize, like we're not going to have a payment forever and ever. We can get these things paid off so that we don't, and, we free up some cash flow on a monthly basis so that we can do other things with.
Yeah, and I've seen some car loans that are also comparable to a mortgage. I've seen car notes as high as $1,200-$1,300 a month. And
ooh, what kind of car is that? What costs that much money?
I know, and some of that's a combination of buying an expensive car and interest rates. That's another thing that people don't talk about. They are shockingly high. It's great when you see 0% interest, or even if you get used cars, you might, and you have good credit, you can get maybe 2 or 3% interest. But there are double-digit car loans out there that are similar to a credit card interest rate. So the combination of those things could end up getting you into a car payment that's equivalent to a mortgage. And if you want to buy a house, you might not be able to. You might need to live in your car if you're paying $1,300 a month and you have student loan debt and you can't save anything. So think about that before you just start taking on all of this unnecessary debt for something that depreciates.
Mm-hmm. Yeah, I think that's a good point, is that a car is not something that you're going to sell for more. I think it happened a couple of times last year during the pandemic due to some unforeseen circumstances. And people were just like, wait, what? This is a thing? And I'm like, no, it's not a thing. This is a weird thing that's happening right now. This is not a normal thing. You will not sell your car. Like you said, it's a depreciating asset. And I think you also brought up a really good point about the interest rates. And just overall, as I think about debt and the various interest rates that exist, like there are so many things that you will be allowed to purchase. So no one's going to stop you from buying a car. You just may pay way more. You may, like I said, qualify for a mortgage while you got student loan debt and credit card debt and car debt and, name all the debts. But they may say like, woo, with all these things you got going on, you are a lot more risky to us. And so we're going to give you a higher interest rate. Which is going to make you end up paying more for that home. And so that's going to, once again, diminish your ability to pay it, diminish the appreciation and things like that. So to be very mindful of interest rates and taking on, like I said, additional debt on top of various other debts, because that is not looked at favorably by the lenders.
Yeah, there's no shortage of people that are willing to lend you money at any cost. And then they're not looking out for your best interest. They're getting a commission, and they make money by lending you money. So, you're the one stuck with the bill at the end of the day. Mm-hmm. So just let's talk about some ways to reduce or avoid car loan debt. Now, the first big one is to buy used. Let's normalize buying used cars. Cars depreciate the most within the first 3 years, and just kind of a good rule of thumb is like 15 to 20% of the value is gone each year. So within that first 3 years, about 60% of that value is gone. So do you want to buy something that as soon as you drive it off the lot, it's starting to depreciate, and within 3 years, over half the value is gone? If you buy a 3-year-old car, even if you want to get a nicer or more luxury car, if you buy something that's 3 years old, you still have plenty of years to get out of that car. You have a good value, and you can make that work.
Yes. Says the girl who drives a 2008 Honda Ridgeline. So we are 12 years and we are still going strong. Harry the Honda, making it work. I feel like I got way more than my money's worth out of that car. So,
yeah.
Yeah, sometimes we just think like, 5 years, this car's old. It's going to start giving me problems. I'm going to spend more on it. I did spend probably like $1,500 the last time I had to get it fixed. But I'm like, oh, if I do the math on that, it's like $125 a month. Like, that's much less than a car note. Like, and if you have a proper emergency fund with cars, I think that's another thing. People don't want to buy used cars because they're like, I'm going to be fixing it all the time. If you have a proper emergency fund and even a car fund, those things kind of, like I said, become kind of like, meh, okay. So me and Harry, we're going to keep plugging along until I feel like he just like is on his real deathbed. But right now we are going. So my goal is to have a 20-year-old car if I can.
Yeah, and again, we're just even talking about, even if you could just buy like a 3-year-old car, and if you buy a good quality car, that car should last you a long time. So just kind of think about buying used versus buying new and what makes sense.
Right.
Another thing is just keep cars longer. Lauren, you said your car is a 2008, but most cars can last at least 10 years. And I mean, there are some good quality cars out there that lasts, well beyond 100,000 miles or 200,000 miles. So it just depends on the type of car that you're getting and how good is that car and what's the longevity of it.
Yeah. And to pay cash for the car as well. If possible, try to buy something that is, save up for something, knowing that a new car may be in your future, so that you can just write a check and be done with it and not have that monthly payment. And then if you do have a monthly payment, to kind of redirect that automatically to kind of next car down the road. So instead of making a car payment going forward, you're kind of already saving up. So the next time around, you don't have a car payment. You can just use what was quote unquote your car payment as your payment toward the car going forward. So let's say, you've been paying $300 a month for the last 5 years. That 5 years is over. You may be able to increase your saving in some other way, like, retirement savings, et cetera. But you may just want to keep saving $300 so that next time that you do need a car, you've got 10, 20,000 sitting aside, because you can you paid a car note to yourself, which saved you a bunch of money on interest. And then you can just write a check and be done.
Yeah, and getting back to the narratives, people just think, oh, I'm always going to have a car note. And so, once the car is paid off, then there's automatically the desire to go get another car and to start it all over again. But if you keep the car a little bit longer, you can save up that money and potentially pay cash the next time. If you are going to take out a loan, I would also say no to 72 and 84-month car loans. That's something that's come out in the last several years, and if you generally can't pay off a car within 3 to 5 years, like, you might need to reconsider whether you can afford it.
For sure. I don't know. Like I said, once again, the narrative, well, not the narrative so much as it is the mystique, or the thing that makes it like really cool is like, oh, this is $100 payment. My car payment's only $100. Whereas if you were paying it over 60, months, which is more normal, it'd be a higher payment, which might put additional stress on you. But stretching it out means you pay more interest over time, which means the company, like I said, the lender, once again, benefits from that.
And then with the way it depreciates, you could end up being upside down. So you owe more on the car than it's worth. Mm-hmm. And that's another thing that we see.
And then you're stuck.
Yeah.
All right. Last thing about cars. What do you think? Anything else that we need to say about that?
Yeah. So one of the rules of thumb that I've heard is, the value of a car that you buy should be less than or equal to 50% of your income. So, as an example, if you make, $100,000 a year, you shouldn't buy a car that costs more than $50,000 as a general rule of thumb. Ideally less than that, but
that's a lot of cars still, I think.
Yeah, but make sure that your car pay, and that, of course, that's not considering all of the other debts and other things that are on your plate. But just make sure that your car payment, another rule of thumb, is less than 10% of your take-home pay.
Got it. Okay, I like that. I think we need to talk about credit card debt too. When we're talking debt, this is a huge one that a lot of people don't realize are weighing them down. It becomes a big expense. It should not be an expense at all, but you get buried in credit card debt quite easily, and it becomes a big expense that you're just kind of on a hamster wheel dealing with.
Yeah, and the average credit card debt's about $5,000, and approximately 55% of people don't regularly pay their bill in full. So that's a huge problem that we have just in society that needs to be addressed. Yeah,
I'm going to pause here. I've said it, I think, on some other shows. I've definitely posted on my social media because narrative wise, what you're hearing on social media is like, oh, well, I shouldn't pay my bill in full. I just need to pay it on time every month and it's going to keep my credit good. No, no, no. Having your bill paid in full each month is going to be much better than keeping a balance on your card, even if you're paying on time, to improve your credit score. $0 on that credit card and it open and in good standing is much better for your credit score than keeping, and the number I hear all the time is 30%. 30% is a utilization number you want to be less than. It is not the number that you want to keep on in perpetuity, try to keep your credit score good. So as an example, let's say you have a $10,000 balance. They say don't have more than $3,000 on that card at a given time, because once you're over the 30% of utilization, that negatively impacts your credit. So you want to be less than that. But the idea is actually to pay that whole $3,000 off by the time it's due, not pay any interest on it, so that you're not paying companies additional dollars by having this credit card debt.
Exactly. And one of the things too, generally speaking, if you don't know how to live within your means, or if you don't understand your cash flow, credit cards can be dangerous. You can rack up that credit card debt. But there are times we're not anti-credit cards. We both use credit cards frequently. But there are times, even if you are anti-credit card debt, or you don't trust yourself to pay the bill off each time, there are times when a credit card is better than a debit card. A couple of examples would be, when you stay in a hotel, they usually put a hold on your card for a certain number of days, and then they settle the bill at the end when you check out. Or when you rent a car, sometimes they put a hold on your card. And so if you have a debit card, you don't want them putting a hold on the money that you need to spend. So credit cards, can be useful for those things, and a couple of other instances as well. So just make sure that you're trying to use it responsibly.
Amen to using it responsibly. So let's talk about how to reduce or avoid some of the credit card debt. So thing number one, live within your means. Really understand your cash flow, your big bad B word, which is budget, inflows, outflows, spending plan, however you want to call it. You need to know what you're spending on, have real clear understanding of that, so that you know that you can pay that credit card bill in full each month. Go ahead.
Yeah, I was just going to say too, it's really easy, of course, with everything, we just swipe every day, or we enter in our numbers online, but it's really easy when you're not directly paying it with cash or paying it with a debit card. It's easy to overspend and you don't realize where your money's going. So just understanding your cash flow and what that looks like really helps you to stay out of credit card debt.
For sure. And then if you're going to pay off debt, make sure that you're working on the actual behavior. So one of the things I see people do all the time is like refinance the debt, consolidate the debt. I got a $0% interest, and they're transferring over to a different card. While in the short term that may be helpful, you go from a 20% interest rate to a 10% interest rate, you actually have to make changes to what you're doing, what got you into the debt, in order for this to actually meaningfully make a difference. If you got 18 months of 0% interest, you got to get really serious about getting that debt done in 18 months. And a lot of people don't do the math on what they need to do, or they can't afford to actually pay it off in 18 months, which what generally happens is, one, you pay 3% to transfer whatever that balance was. And then once the 18 months is up, you get a much higher interest rate than you would have gotten with a normal credit card, because they knew, like, they were betting on you to not be able to pay it off over that time period.
Yeah, definitely. Another thing that I see a lot too is having way too many credit cards. I've seen people who have 5, 6, 10 credit cards, and they're charging a little bit here, a little bit there, spending some money out of their checking account. And I'm just wondering, like, how are you keeping track of what's going on in your world and how much you're actually spending? If you're just, it almost feels like people just, whatever card comes out first out of their wallet, it's like, that's the one we use. But just try to keep it simple and stay in control. There's no way that if you have multiple credit cards that you're keeping track of, or doing a good job of keeping track of what you're spending.
Yeah, for sure. And the reason I hear all the time that people are, the 10 different cards is like, well, this one is for my points on Southwest. This one's for my points on this airline. This one is my cash back card. And before you know it, like I said, you're in credit card debt. And so many people have cards specifically to, take advantage of points, other benefits, free concerts, etc. But if you can't pay your bill in full, that interest rate is going to hammer any benefits. You got 100 points and you get $10 of credit or something like that, and then you paid $50 in interest on that card because you didn't pay it in full. It immediately wipes out any benefit when you can't pay your bill in full.
Yeah, definitely. And if you're trying to build credit, I know that's something that a lot of people want to do too. If they're preparing to buy their first home, or maybe they just don't have any credit and they want to build it up. Credit cards are kind of the first go-to for a lot of people. But if you're trying to build your credit, just, don't go big, don't go maxing out the card. Just, try to charge a small amount for a bill that's recurring. You already know that you have to pay it each month, and just set it on auto pay. Like that's the best way to just kind of start to build up credit history. But just don't go into a deep dive with your spending on the credit card, thinking that you're building your credit, because you just could end up getting in credit card debt.
For sure. All right. I think you guys got the 3 big expenses: taxes, home buying, and debt. Just good old fashioned debt that just sucks up your monthly income and is not allowing people to create wealth. As we kind of start to wrap up here, I think of some like general debt tips. And, number 1, understand your credit score. So your score needs to be a healthy number, over 700, in order to, take on additional things. But ultimately, your credit score is going to allow you to take on additional debt. So narrative again. Oh, my credit score. What's your credit score? Oh, I got to get my credit score together. Give me some credit repair. Credit. They're looking at their credit score daily. Some people are logging into apps and things like that. Credit is a means to take on additional debt. Debt is something that we don't want to take on. So
right.
Be mindful of the idea that while you want to have a good credit score, you don't, it is not the end all to be all. And I know plenty of people who have a good credit score that actually are not financially sound right now. Simply being able to pay those bills every month might give you the good credit score, but you may be drowning, and like I said, in that paycheck to paycheck hamster wheel that we were talking about.
Yeah, definitely. And I mean, there's people who are financially independent. They can pay cash for everything. They might not have a great credit score. They might not have credit, but they don't need it because they can pay cash.
Amen. So do your research. Make sure you really understand what you're getting into as it pertains to all the different debt vehicles we've talked about. Think about the taxes, fees, warranties, etc. that, can pile up on you, and try to pay those with cash. And do not refinance. This is actually a really good thing that we didn't talk a whole lot about. Things like that into your loans. So that is something that I see happen all the time. And even, what's gotten popular now is people will pay off their car with a refinance of their mortgage and tie their car into the collateral that is now their house. Your house is what you want to live in.
Credit card.
Right. Credit card debt is another. Yeah. So there's collateralized and uncollateralized debt. And then there's, like I said, the actual home, the place that you want to live in has some additional protections that other things don't have. So should poop hit the fan, you don't want someone to be coming after you. Don't tie up all these other debts into the place where you need to keep the roof over your head. If you get in a bad situation, you can't pay your credit card debt. They're not going to take your home because you didn't pay your credit card debt. However, you pay off your credit card debt, dump that debt into your house. Now you may be on the struggle bus because your house is unaffordable, and they can actually take your house because, foreclose on it, etc. So you want to keep those debts separate as much as possible.
Yeah, and like Lauren said, be careful with the taxes, fees, warranties, all those things, whether it's a home loan or a car loan. When you add all those things up and you roll it into the cost of the loan, and then you put, little or no down payment, that basically just increases your likelihood of being upside down on your loan. And that means that you owe more than what that car or that house is worth.
Yeah, we don't want to end up in that situation. All right, final takeaways. Is there anything else you're thinking of, Chloe, as we wrap up this episode?
Yeah, the big thing here is that, we gave you a lot of rules of thumb and things to think about, but, you really have to understand your big picture and your long-term financial goals. At the end of the day, whether you're trying to reduce your tax liability or you want to buy a house or you want to, get a new car, or go back to school and get a graduate degree, you have to understand like how those things factor into your big picture and how they affect your long-term progress towards financial freedom.
I love it. I love it. I love it. All right, let's head to today's money quote. It is, wealth is not the same as income. Let me just say that part again, because we didn't even get to the good part of the quote yet. Wealth is not the same as income. If you make a good income each year and you spend it all, you are not getting wealthier. You are just living high. Wealth is what you accumulate, not what you spend. Chloe, where did this quote come from?
Yes, this is by Thomas Stanley. So we're continuing with his quotes for this week. But this is a big thing that what we talked about the Millionaire Next Door last week or last episode, and you have to understand that income and wealth are not the same. There are a lot of people who are making $500,000, $1 million, or several $1 million a year, living paycheck to paycheck, and there are people who don't make half of that and are able to retire early. So it's about what you're able to accumulate.
Yes, saving is such a big part of this picture. Saving a little bit of whatever it is that you're earning could put you in a really great situation. All right, we are ready to wrap up this episode. I hope you all enjoyed it, learned some good information about the 3 big money expenses that kind of ruin your road to wealth. Next episode is coming up just around the corner. Every 2 weeks, we are dropping the bombs and the nuggets for you. Chloe, what is our next episode?
Yeah, so our next episode, we're kind of continuing along this spending phase because we want to hammer this in, just all the different ways that can prevent you from building wealth. And so a big topic that we see, especially in communities of color, is helping friends and family. And so we will talk about, when you're the first person in your family who's made it, the pressure that you have to take care of friends and family, and just how to balance that with also making sure that you're taking care of yourself.
Yeah, we like to refer to it as the first generation wealth builders tax. Some people are like, what, a tax? But yeah, it basically is in the way that it kind of plays itself out. So can't wait to talk to you all more about that. Definitely, like I said, check out the show notes. We've got tons and tons of resources for you. And we will see you in just a couple weeks.
Bye.